All right, we're live. First, I want to say thank you to the Bitbox O2 Bitcoin only edition for sponsoring this podcast. If you haven't heard of it yet, check it out. It's a very easy to use hardware wallet, so a lot of beginners. It's suitable for a lot of beginners, and I know some that are really enjoying using it. But it's also got a lot of great features for the more hardcore among us. Like connecting via Tor, connecting to your own node, coin control, rolling your own seed, all sorts of great features, and it's fully open source. So I've been having a good time with it. You can also use it with Spectre and Sparrow and a number of other wallets. If you would like to learn more about it, and you should, because of course, as many of you know, and any beginners here, you need to be taking custody of your Bitcoin. If you don't custody your own Bitcoin, you are not Bitcoining. So if you want to learn more, go to shiftcrypto.ch/rapid fire and you can get yourself 5% off. Aaron Segal, what's up, man?
Hey, how you doing, John?
I'm doing good. How are you?
I'm doing great. Doing great. Just enjoying the post-holiday festivities here.
Nice. Yeah. So you're a relatively unknown Bitcoiner, although I suspect your profile will grow rapidly. You've written 2 articles for Bitcoin Magazine. One is called Bitcoin Information Theory. The other one is called, remind me again of the title.
It's the pitfalls of the inflation narrative.
Right.
Yeah.
Both really great articles. And hopefully we get time to dig into both today. But one of the, Bitcoin Information Theory, I think a lot of Bitcoiners have an intuition or maybe even, thought more explicitly about that concept, but I felt that you explained it really well, put a lot of meat on that bone. And it's one of those things that in our various debates with the fiat academics and economists, they totally miss the value of a hard cap money. The is pervasive, and this is what they get on with. So I'm hoping today this conversation can shed some light on your writing and give myself and other Bitcoiners some more ammo when we have those debates with the fiat economists. So why don't you get us kicked off with a brief intro to yourself?
Yeah. So just brief background. My background's in finance. So I've been an investor for longer than I'd like to admit. Over 16 years working in the kind of hedge fund community, investing in all sorts of different asset classes. Fell down the Bitcoin rabbit hole a couple of years ago, fell super deep down the rabbit hole last year, and really decided to put more effort into the community. And essentially, the article that you're referring to was, as you just described, is something that has been marinating in a lot of our heads for some time. Kind of there's so many interwoven narratives and connections with so many themes in Bitcoin. It's sometimes very hard to whittle it down to one big idea. And I think that's why sometimes it can get overwhelming when you're trying to convey these thoughts to a new or pre-coiner or an altcoiner, or just really try to explain why this is such a fundamental shift in how we communicate value. And so I was trying to basically come up with a way of really filtering it down to its bare bones and understanding at its deepest core, philosophically and almost like mathematically, why Bitcoin is so important. One of the ways in which, one of the routes that helped me kind of coalesce around this idea was the concept of deflation, and the concept of deflation not being something that we should be fighting. And of course, Jeff Booth's book, The Price of Tomorrow, really did an incredible job of articulating that idea. And this wasn't an idea that necessarily wasn't around. I mean, I think you can go back to like 2014, you have like Larry Page talking about this even, and there were, around the periphery of the tech industry, there was actually kind of a lot of an inherent understanding of this. I think for most of us who are not technologists, who are not part of Silicon Valley, we were swimming in a little bit of a different ocean. And for me, I was swimming in the ocean of inflationists and Keynesian economics and all of those concepts that we didn't even think were concepts. We just took them as part of the air around us. And one of the reasons that Bitcoin spoke to me so passionately was it was something that I had a problem with for years. I'd been investing in markets before and during the great financial crisis, and I kind of saw all of the outcome of QE. I saw the outcome of the commodity boom in 2005 and what that did to the housing market and all these different interplays. And then after the crisis, how that narrative, and we can talk about this later, but that narrative of inflation coming and the money printer being unleashed upon the world, and how it didn't actually result in at least a tangible inflation. It didn't, it ended up resulting in a lot of asset inflation, and I think we had to have a lot easier time differentiating the two now. But back then, they were kind of hard to differentiate, and it was very confusing. And I remember just sensing that something wasn't right, and just sensing all of my preconceived notion, all of the economic courses I had taken, all of my understanding of inflation being this good thing, kind of intuitively started to break down. But the problem is until you have an alternative, until you have something else that can offer a better way, it's really hard to embrace those ideas, that itch that something's not right. And so I think we all have felt that and have all come to Bitcoin from various ways. That's how I came to Bitcoin, because it finally clicked that this is the solution. I mean, I think that's a huge differentiator between Bitcoin and gold, for example, because gold tells you, gold bugs have intuitively understood a lot of these fundamental problems, but they never offered a solution. There's no way, you can't go back. Once you go into a creditor fiat system, it is a one-way journey. And gold is part of the history that was untethered from that. And in order to rectify all of those problems, you need a solution made for the modern era. And gold is not that. So I think Bitcoin
just to stop you for a second, but that's part of the reason why, because I was a gold bug before Bitcoin, in the early 2000s. And it's such a depressing thesis to adopt, because basically what you're saying is all this is going to shit, and I need, gold is going to be your fallback when things go to hell, but you're almost wanting, to actualize your investment thesis correctly. You're almost wanting that scenario to play out, and now gold bugs will have, different explanations and call it a hedge and that kind of stuff. But that was honestly my thought. And so, I definitely agree that gold, first of all, it's impractical. I don't think we're ever going to go back that direction, even if there is a massive collapse of some kind. But it's certainly not a hopeful, mind space or headspace to be in as an investor, because you're kind of hoping that the worst case scenario actually happens. And that's why Bitcoin is so powerful, because not only do you see it as a solution in the next stage of money, but it's actually, you're hoping for something that's, orders of magnitude better than what we have right now, and I think that's part of the reason why it influences people so strongly.
100%. And I've also had my flirtations with gold and I do believe that there is that inherent desire that once you start investing heavily in gold, you kind of are hoping for Armageddon in some way, at least from your financial self. But yeah, gold, because gold doesn't offer a solution. Gold is just a protection. Gold is a bunker. Gold, that's why people associate gold bugs with the tinfoil hat and the sky is falling type mentality. And then kind of bringing the topic back to the whole point of this article, which is really centered around this concept of monetary entropy, which is that, first of all, gold does have monetary entropy, whereas Bitcoin doesn't. Gold is centralized. Bitcoin is obviously not. And also importantly, gold is not scalable in the same way in a digital world. So anyway, like kind of getting back to your initial question, as to kind of how I came across this concept. So I would say Jeff Booth's concept of really helping understand why we're kind of spinning our wheels a little bit as we try to inflate in a world that naturally wants to deflate. And that is a really key understanding to both this article and I think just to Bitcoin in general, and what Bitcoin can help the world accomplish and help us kind of basically get off of this hamster wheel. Because like I said before, you can't get off a hamster wheel that you don't even know you're on. And so that's first and foremost. Bitcoiners now realize that we are on this hamster wheel, but there needs to also be, Bitcoiners are very keen and aware of financial incentives and behavioral incentives. And you cannot tell someone, even once you show them the proverbial matrix, the old, if you red pill somebody or orange pill them in our nomenclature, there still needs to be an incentive to move to a different system. And I think Peter Thiel talks about it in his essay 0 to 1, how you need kind of a 10x improvement in a new technology to incentivize people to move off the previous one. And I'd like to come back to that actually, because I think that's an important distinction as well. But just for those who haven't read the article, the basic thesis is that there's real world energy. Throughout history, the purpose of money has been a social technology. It's been a technology that allows humans to scale via communication of value. And the best monies do that with the least amount of uncertainty, in the least amount of trust required. Because the more trust that is required, the more work must go into just maintaining that trust and not producing other value outside of that. So the real key to money is its ability to do something as a transmission mechanism that allows the actual value that's being produced by society to propagate. So money is this weird technology. And then when we think about technology, we think about things that do all this stuff, right? That make the world better by creating some new thing, new product, new service. But what's unique about money as a technology is its ability to get out of the way and to allow the value to really accrue in its most pristine form. So as I was thinking about that, and as well, I think tied to all of this is this debate about Bitcoin's energy consumption. And this straw man argument that's being proposed that Bitcoin is not only, using way too much energy, which we all know, I think, to be false, just in its absolute, sense, but it's also trying to hide the ball. Like I said, it's a straw man argument. You're basically, you're taking the conversation away from its true variable. And the true variable is, what is the alternative? The alternative is a fiat inflationary based system, and the incentives that system basically perpetuates. And those incentives are extremely deleterious for efficiency, for creating parsimonious use of resources, and it really incentivizes consumption and all of these things that are way orders of magnitude worse for human environmental balance than Bitcoin. So you're talking about this like minor detail about Bitcoin's actual thermodynamic energy consumption, which is also falsifiable. But you're really trying to shift the narrative away from the elephant in the room, which is the entire system's horrible utilization of energy. So with those kind of background states in mind, I'm trying to kind of weave this all together. And we all know that Bitcoin does use thermodynamic energy. There is a cost of the monetary production, which is very important to Bitcoin, both from a kind of inherent value and also from a security standpoint, of course. And then we also know that there's, I came across Claude Shannon's information theory. Now, Claude Shannon was a computer scientist from the 1950s. I believe Alan Turing and Claude Shannon are probably dubbed, the two most influential people in computer science in terms of the development and step function in innovation there. And Claude Shannon's real observation was information theory. And that's really what kind of clicked for me, which is, so the whole concept of information theory is that in a network, the whole point of communication is to reduce uncertainty. And as I'm reading that, I'm thinking, well, that's money. That's what money does. Okay, so money is information. And that led me down that thought process. And then when you kind of combine thermodynamic energy and the use of work that we produce in society, all of the work that we do, everything we do to produce goods and services and innovate and put food on the table and hunt and gather, all of the things that humans have done throughout history are various forms of thermodynamic and entropy, because you are doing work, and in doing that work, the second law of thermodynamics states that, well, the first law, just for everyone's edification, is energy can either be created or destroyed, and the second law is that entropy is always increasing. And entropy, in its simplest form, for the purposes of this conversation, can be thought of as going from more order to less order, right? To something that can be known, to something that dissipates and that is harder to quantify, to define. And in terms of physics, that is referring specifically to energy. And over time, that arrow is completely true, which is that entropy is always increasing on a kind of geologic sense and a cosmic sense. But there's a famous physicist, Brian Greene, who I love the term he uses, which is the entropy two step, which what he means by that is, yes, entropy is doing that, but it's doing that in a nonlinear fashion. In the scale of humanity, we are creating entropy, but we are also decreasing entropy with our actions and our behavior. So he talks about this dance where entropy goes up over the long term, but there's waves, and there's ways of decreasing entropy. And that's basically all human action, is our fighting of that long-term trend towards greater entropy with our ability to create little pockets of lower entropy. And so when you kind of combine this kind of physics concept, this very basic physics concept, with this very basic information theory concept, you can kind of get to this equation where, as we create more thermodynamic entropy, we are decreasing informational entropy. We are making order out of the information in the world, or out of the data in the world. And when we are dealing in the physical world, as we've done for most of humanity's existence, it maybe is a little harder to make that connection. But as we move to a more digital society, and information is exploding and data is exploding into our kind of consciousness all around us, and we're creating all of this information, it becomes much more obvious that there's a connection between information and entropy. And once you make that further connection, that money is a form of information, you can start tying this all together. So the big equation is thermodynamic entropy to the power of innovation, and I'll get to that in a second, minus monetary entropy equals negative informational entropy. And when I say negative informational entropy, I just mean lower entropy. Okay, so I know it sounds a little highfalutin and it sounds very abstract, but at its core, it's really just a great mental model. And it's actually saying something quite simple, which is that as we do more work, we try to decrease informational entropy. And what helps us scale that is innovation. Technological innovation has always been humanity's main tool for scaling any type of progress, any type of work we do. And that's why, of course, technology can scale exponentially. And that's why in this equation, I've used it as a power law, because it is something that can scale exponentially. What prevents that, that is the natural state. That is what free markets want to do. The wrench in that equation is the monetary entropy. And for the purposes of this article, and just to keep things simple, I define monetary entropy as money, information, our basic form of monetary technology that is inflated. And as long as you have an inflationary money, that monetary entropy variable will be a positive number, and it is subtracting from the innovation that we are creating. And that very much gets back to Jeff Booth's concept about how we are spinning our wheels, that innovation is constantly deflating, creating more for less. And we are in this system that has created incentives where those interests are not aligned, where we cannot have a deflating money. And I'll get to that in a second as to why that is the case. But so basically, anytime you have positive monetary entropy, which is any kind of inflating fiat money, you are degrading the entire system's ability to progress and to create value and to express value and to create informational order out of thermodynamic disorder. I'll pause for a second because that was a mouthful.
Yeah, I mean, I'm dialed. I mean, I think maybe just to characterize the relationship, what you're saying basically is the use of power, right? The thermodynamic entropy, increasing thermodynamic energy, right? Bringing power to bear on something is what allows us to order our world, right? Reduce entropy on the other side of that equation. And that is the creation of value. That is how we come up with things that we then value, right? Taking, high entropy energy, power, increasing thermodynamic entropy to produce greater order on the other side of that equation. I think it would be great for you to go into further detail about why the money matters as a mechanism of information transfer between those two sort of realms or sides of the equation.
Well, I think, first of all, you characterized it perfectly. And I think the best way to answer that is to first start with the presupposition that Bitcoin has zero monetary entropy. An asset that, I know Bitcoin still has an inflationary algorithm, but we all know that—
assuming the hard cap. Yeah.
yeah, exactly. But it is a asymptotically, decreasing level of inflation, and will eventually, its eventuality is that of a deflationary money. And the reason it is a deflationary money, and the reason it has zero entropy, is because it does not create misaligned incentives. It does not create any type of noise between one end of that formula and the other. And that is, I think if you want to visualize it just in its simplest form, you have a line of communication, you have various nodes within a network, and they are trying to communicate value to one another. And I think you made that point in your last comment. You used the words that all of the entropy we release through our work is done in order to create value. That's essentially at its core what we're doing. And all of that a good money does is allow that to occur. And so, that's why you can't have entropy that's below zero. You can't have money that's creating negative uncertainty, because to state that monetary entropy is zero, you're saying that there is no uncertainty in the transfer of that information. And that kind of gets back to what Claude Shannon was attempting to accomplish. He came up with the concept of a bit, and as you're transferring digital information from one end of a node to another, how much uncertainty is there? If there's zero uncertainty, that communication is pristine. Mm-hmm. And I think that is a little bit hard for even Bitcoiners to accept, because part of the problem is it then takes away from even discussing. Like, we can sit here and have this entire conversation and not even talk about the many, many positive attributes of Bitcoin as a network, as an asset, as a technology. If we understand just that main underarching accomplishment of having zero monetary entropy, we can basically just relegate the conversation to humanity and all the value that we're creating naturally. And you talked about, it's very interesting, as I've come across. I'm a big fan of Hayek, and so Frederick Hayek was a libertarian Austrian economist in his day, and he actually said something in the late 1970s he was basically talking a lot about private money, where the bank, what if you privatize the ability to create money, and it wasn't in the hands of the government? The government didn't have this monopoly, and that money would be created and be this kind of competitive product, right? And that banks would be incentivized to create good forms of money. And he talked about a money that appreciated too much as being detrimental, and how that he couldn't really see that happening.
Depreciated too much?
That no, that appreciated in its own value. So a
deflationary
money, deflationary money that was appreciating versus all other goods and services and other forms of money as being is being feasible. Yeah, he didn't see it as feasible. He said it could be a great investment, but it wasn't a good money. A good money needed to be stable. And maybe this is semantics. Maybe we're just talking about, he's looking at a timeline. But in my mind, we've never lived through the monetization of a money at in basically one generation, in the span of one human being's life. So it's very hard for us to conceptualize that process of monetization. And I think Nick Szabo, for example, does a great job of discussing why a store of value must come first. But the reason I'm mentioning all of this is because I can perceive a situation in which a deflationary money has so the reason he says that a money that's appreciating too fast is detrimental is because he assumes that there are lots of debt in the society. And if you do have debt and the money is appreciating versus that debt, the debt of course balloons relative to that money. And that becomes very problematic, and no one's going to want to take out debt when tomorrow the value of that debt is going to be way higher than it is today. But that's assuming two things. One, that's assuming that the debt is there to do something beyond create value. So if you had a pristine money that was there to allow that transfer of value and that communication of value, the only reason to take on debt in such a background state would be to create innovation. And the risk-free rate associated with any debt in that system would be just that difference in the value that you are creating. Now, of course, there's counterparty risk, and you can add some kind of spread on top of that, but that's why I said it's the risk-free rate. So even someone like him, who is probably, in most of the things he discussed, was a very staunch advocate for all of the things that a lot of Bitcoiners stand for, couldn't visualize a world beyond the world we live in. And that just speaks to how hard it is to get our heads wrapped around, a concept of something like, hyper Bitcoinization, and getting out of a system that is inflationary, and inflationary in such a way that the only way it perpetuates itself is through credit creation. And yes, that's true. If you have a credit society, a fiat creditor society, you cannot have a money that is inflating against that and maintain the two. They're irreconcilable beliefs. So I think that is, and that led me down to the second article, which is talking about the different types of inflation and how not all of it are the types of inflation that a lot of Bitcoiners like to discuss, which is like that kind of consumer goods inflation. A lot of it is just debt inflation, asset inflation, and all of these things. The common similarity they have is they create entropy. They don't necessarily increase prices all the time, and you're not going to always see those price increases, especially because there's those deflationary forces, to the point of what guys like Jeff Booth talk about, that are occurring underneath the surface. And that's the other thing that I think people miss a lot, is that this monetary entropy is very insidious, because you don't know what the value could have otherwise been. We've had 50 years of this kind of information age renaissance, and what could have been created? What would the iPhone 12 be had it not been for the inflationary incentives that Apple was operating on? Yet, yes, they created this great deflationary technology, this computer of Apollo 11 spacecraft level computing power that we can all put in our pockets now, and that's massively deflationary. But it could have been way more deflationary had Apple not been operating in this kind of cosmic inflation background that they're operating in, because they have misaligned incentives too. So even a technologist is dealing with incentives that lead them to create some monetary entropy. So that's
I'm fascinated. I mean, we'll never know, right? It's all speculation. Like, where would we be now if we didn't lose all that productivity or all that innovation, or if it was more equally distributed? People tend to think that we're in it's a high-tech world. We have Netflix, iPhones, and that, it's never been better. And that there may be truth to that. But how much better could it have been by now if we were on a different monetary standard? Ultimately, it's moot, right? Because this is the process of evolution of money. I mean, we couldn't have had it any other way, I don't think, and we can lament how it evolved in certain eras in history, but it is what it is. And we should, we can celebrate the fact that Bitcoin is here now to just absolutely rectify most of these, at least monetary problems. And it's amazing to think about what happens when a money like that is the dominant money that coordinates activity and the people use for their savings. I mean, how much cheaper will the world become? And then, as you mentioned about the risk-free rate, I mean, when that's not being artificially manipulated, what is the cost? Like, what is the bar that you have to overcome to actually create value in the world? Presumably it would be higher than it is now, right? And so, to use an overly trite example, like less plastic shit in the aisle of Walmart and more high value things that actually amplify the quality of life and human flourishing and all that kind of stuff. I mean, I don't think that's a difficult leap to make. But one thing I wanted to say about, you were talking about Hayek and his kind of difficulty in seeing how this could unfold or understanding this stuff. And I've come up against that in some debates recently. And it's such a misnomer or a misguided objective to want stable prices, stable particularly, because prices are information about preferences as they're communicated in the market in relation to the environment that people are acting in. And so when you have a constant supply money, and they'll even explicitly say this, they'll say, hey, if you have a constant supply money that totally inelastic, that can't be changed, then all changes in preferences must be reflected in prices, because that's the only thing that can adjust. And it's like, yeah, exactly. That's exactly the function of prices. You want anything else is noise, as your article, explores in greater depth. Like, if you're willy-nilly changing the supply of money out of some misguided objective of stable prices, you've introduced usable information into that system, right? You've neutered the money's ability to actually communicate what it's intended to communicate, which is the preferences as they change in relation to changing environmental circumstances. And they just can't appreciate that. They look and say, well, it's too volatile. It's like, to take something from 0 people owning it with a $0 price tag on it to 8 billion people owning it with an whatever price tag, per Bitcoin, there's going to be a lot of volatility as a function of the organic adoption process, but also because as people realize the asymmetric upside returns that process permits or represents, then there's going to be all sorts of speculation and leverage and all this kind of stuff. But ultimately, when it's fully distributed and it's just used as money, then my opinion is that the volatility will come way down and the price differences will effectively reflect the deflation that's happening, or the deflation in the money will reflect the productivity in the economy. If the economy grows 5% a year, then the price of the money grows by roughly 5% to account for the new goods and services it has to price and transact.
And that's your risk-free rate. That's your risk-free rate. That's your hurdle rate.
Exactly. And then, and they say, well, everyone will just be hoarding. You won't get productivity. It's like, what are you talking about? Productivity is a function of the capital stock and time preferences, right? So look, what is the demand for capital? And does someone's belief that they can provide greater value to a market exceed the cost of the capital that they're forced, the rate that they're forced to pay to borrow, to access capital? Right. So you could easily see a circumstance where someone says, yeah, I can build a business that has a greater than 5% per year per annum return, and as a result, access capital or justify the cost of capital, that that's available to me. So I really feel like these fiat economists, and even, you know, the good guys, as it were, like the Austrians, they really miss it on a couple of these points about what money really truly is. And again, they can be forgiven because a hard cap, totally inelastic money was never in the realm of possibility. I mean, it's a complete mind bender that that's even possible, that we have something in the human realm that seems to be able to credibly enforce an absolute scarcity. I mean, and this is what the shitcoiners miss and everything, but that is, you know, as you say in your piece, I actually think it's a good paragraph to maybe read. Just give me a second to find it. It's where you use the term rabbit hole.
Oh, I think it's the. Okay, so there's a section, inflationary monetary systems obfuscate the value created by societal productivity. This simple statement cannot be overstated. Since the early decades of the 20th century, we have errantly accepted inflation as a first principle necessity of all free markets, but it is not the natural economic state in a broader historical context, and it is actually a fairly recent experiment. See Gibson's paradox, and Gibson's paradox refers to actually the lack of correlation between those two variables. But I go on to say, quite the opposite is true in terms of the natural state of human progress in free market capitalism. Once this problem is truly appreciated, the value of an absolute scarcity that is verifiable, immutable, and censorship resilient across time and space, as well as stateless, we suddenly realize just how incredible of an invention this truly is. That is the rabbit hole that is Bitcoin.
Yeah, that's the one. And then the notion is subtle, but once understood, the gravitational desire to dive headfirst down the rabbit hole of myriad societal revolutions becomes an inescapable journey, right? And that characterizes where Bitcoiners are at with just how mind-bending this realization is and all the implications.
And that gets back to why a guy like Hayek had so much trouble, because his only alternative in his mind at the time, and which of course, what else could he have, was gold. And gold doesn't scale further. If it had been able to scale society further without requiring centralization, which then in turn led to the inevitable incentives of debasement and fiat systems, how could he see it scaling on the other side of it? The only way, and this gets back to the beginning of our conversation, where it's kind of gold bugs didn't have a solution. They just had a way to profit or hedge against these negative outcomes. And the only way that gold could kind of respond to such a situation would be to increase in value. But what he misses, and there's a little bit of an apologist aspect there too, which is that like you're not unwilling to accept the fact that debt is what perpetuates inflation. Like debt is really the incentive creator. And it is, again, once you kind of go down that path, there is really there's no way to turn back. And that's why the solution has to come from outside that system. But you made a really great point before, talking about hoarding. You made a comment about hoarding, right? And how, you know, hoarding itself is such a negative connotation to it. And I think that speaks to just how far off the rails we've gone in terms of basic economic principles. There's one way to create value. There's only one way, like to create incremental new value. It is to have excess consumption. Okay, so you need, in order to create further improvements in any civilization, whether it's 2 people on an island or 8 billion people, there needs to be excess consumption. There needs to be savings, and that, of course, leads to investment. And more importantly, that leads to specialization. And this also gets back to this kind of, I think, misconception about money. We think that humans were kind of bartering, and in these kind of tribal states, we were just kind of trading goods and services, and then eventually we decided to scale by creating some form of money that allowed us to create a medium of exchange, right? And it was a way to create a way of aligning preferences that weren't aligned previously. Like, let's say I had 5 cows, and but the guy was trying to, buy something from, didn't want 5 cows. So, it's logical to kind of jump to that conclusion. But if you actually kind of look at the anthropological evidence, and again, this is what kind of Nick Szabo really did a great job of talking about in his article Shelling Out, is that store of values always come first. There's an inherent desire to store excess value, and that needs to come first. You need to have excess savings. You need to have a savings technology first and foremost before you can then specialize, and before you can then have a medium of exchange. Because a medium of exchange allows you to take that excess savings and say, I no longer need to just hunt and gather every day. I can now develop a new skill. And that's what innovation is. And then that creates value, and that creates new excess savings. And that allows somebody else to develop another new skill, and so on and so forth. And all these nodes start to interact and create a network effect, which is that of economic value scaling. And money just allows that to happen. And at some point in history, centralizing that process had its purpose. But we've kind of reached the limits of that. And again, this gets back to why a guy like Hayek can't really fathom what comes next, because we didn't have a savings technology at the time that could scale into this next epoch, right? So that gets back to your point about, like, stability is not necessarily desirable nor possible nor plausible when you're moving to a new system. And if a savings vehicle, a savings technology, which at its core is what Bitcoin is a necessary step, and it must come before that medium of exchange. And I think even more specific to medium of exchange is medium of specialization, the division of labor. And let's look at the way our society is shifting now with the digital age we are in, where there's just so many different ways to specialize and to scale, and in all of these kind of connections that are forming are no longer like business to consumer. They're no longer, that was kind of the innovation of the internet, which was like a matchmaking system. It was a matchmaking network that still, and that's why it really lent itself to a lot of centralization once we kind of better understood that, because it was a seller and a matching a buyer. Whereas so much of the social innovation that's occurring now and that will likely occur in the future is going to be types of technologies that are peer-to-peer. And I think Lynn Alden actually had a great interview recently where she differentiated, network effects. And, I think an important distinction that a lot of people don't think about when they talk about the term network effect, they just use the term very generally. But there are two different types of network effects. And there is that peer-to-peer, which is that very classic telephone example, where, you have two users, you have one telephone, one user of that telephone. Well, it's useless. You have two, and okay, it's not scaling exponentially or anything, but it starts to have some utility for those two users, and then it scales. I believe the formula is n, which is the number of users, minus 1 times n divided by 2. And that is a peer-to-peer network. A business-to-business or a seller-to-buyer network is just the number of buyers and the number of sellers multiplied by each other. And if you do the math there, the first form of network effect scales much faster than the buyer to seller network effect. And most of the innovation we have seen in the past 30 years has been the latter form of network building. And I think what's interesting about that is some of that is just kind of the nature of the evolution of technology. And we're maybe entering a new phase where we are step functioning into an even more interesting type of network effect that requires immediate, like a currency that can allow people to specialize more, that is in the digital realm, that is fully decentralized. But also, I think some of the reason that occurred was because all of that innovation was swimming in a sea of inflation. And inflation systems incentivize debt, they incentivize capital, they incentivize short-termism and high time preference and the misallocation of capital and all those things, which are essentially just specific examples of monetary entropy that are the basis of that formula. So that the types of network effects that can really blossom are those that have that more centralized capability, because the incentives of the underlying system are more profitable to develop that kind of rentier system where you can insert yourself between the buyers and the sellers. And yes, the outcome still might be a net deflationary outcome, but it is not nearly as deflationary as a potentially peer-to-peer system, as a fully decentralized system would be. And it is not nearly as deflationary as it could have been if we were in a different underlying system where all of that capital, all of that excess savings was not being reinvested back into future innovation, but rather into gaming the existing system instead. And I think a great example of that, for example, is Amazon. We think of Amazon as this great deflationary force, right? Because now we can go and you and I need something, maybe even, where you are right now, like, you need something and literally it arrives the next day at no additional cost. And it's the lowest price you've seen. And you have all this pricing transparency and all these beneficial things of online shopping have all been kind of pinpointed into one specific marketplace, that is the Amazon marketplace, and that is deflationary. But what people don't realize is that comes at a cost. The reason that Amazon can do that is because they actually created a truly deflationary innovation, which was AWS, which was Amazon Web Services. And what Amazon Web Services did was it said, okay, all these people need, there's all this data, there's all this information that people want to use. They don't want to have to store it on their own, on their own network and their own databases. So we'll create a system that maximizes the efficiency of that and that frees up capacity and is more parsimonious to people's utilization of their data. That is actually deflationary. That is actually, an innovation that is, truly deflationary. And it's as a result, it's extremely profitable, as it should be. And they took all of that deflation and they reinvested it. They exported it into this retail business, which is allowing them to scale by centralizing network distribution, which is not an inherently, easy thing to create deflation out of. It requires massive amounts of investment and centralization in order for them to provide those services for us, in order for them to destroy all of their competitors. So to me, that is where you're living in an inflationary world, and all of that deflation that is being created is actually just being recycled back into these inflationary processes. And if you actually take it a step further, what is the end game for Amazon in their retail business? Not to sound trite, but it's, kind of world domination of retail and logistics. And how is that deflationary? That is very centralized. That is a lot of pricing power. They may continue to subsidize it. They may continue to subsidize the consumer in that way, but that's not deflationary in its truest form. So that gets into some of the nuance when we talk about all these innovations and all these things that seem great. But again, how much greater could they have been if the incentives were different?
Yeah, I think that's a great point. And you mentioned a few minutes ago, you brought up truth, and just maybe to put a final pin in the well, maybe not a final pin, because I want to ask you something about this, but prices, the higher fidelity that the money can carry the information regarding preferences of people's action, the better, right? The market will select for that because it'll allocate resources more efficiently, right? And that's what the market will select for. And so that, to maybe bring it into the philosophical realm a bit, although not really, but that is the propagation of truth. That's what it's supposed to be. And like anytime you try to dilute that, you're saying like, oh no, let's dial down the truth a bit, and so of course the question emerges, well, who's incentivized to dial down the truth, right? Who's incentivized to muddy the water? And of course it's the people that benefit from seigniorage of money production, right? And the ability to allocate the value, I guess, of the truth that's attempting to be propagated. They take off a slice of that, and then they become the purveyors of that truth, and the market values that truth, and therefore the value accrues to them. And so again, like I think it's so funny that people who think about this kind of stuff full time don't realize how insanely unique and how much of an innovation it is to have like a closed system so that the price signal can be of the utmost fidelity. I mean, literally cannot have more integrity in communicating the truth of the preferences of the behavior of people acting in that market. So I think the market selects for a money like that because it more efficiently allocates scarce resources. And then of course, individuals select for that because it allows them to preserve the value of their sacrifices, their time and energy sacrifices. So you put those two things together, I mean, the incentives, it's going to happen, right? Barring some catastrophic change, is going to happen. But back to what you were, talking about just then, I'd like to dig in because, the environment and climate change and all that kind of stuff is a very prevalent topic today. And I see one of the major problems, or one of the reasons why that issue, to whatever extent it actually exists, I know there's a lot of debate on that, but I think we could at least agree that there's excess environmental degradation happening today. Even if the climate change stuff is nonsense, I think there's excess environmental degradation and waste. And I do think the biggest cause of that is the dilution of the messages that occur between, human action and the environment, let's say, and how they get propagated, right? So how changing information in our environment how human behavior is influenced by that, and then how that gets propagated by human behavior into the broader market. I think, and that's an insufficient explanation, but I think that is the cause for a lot of our environmental issues as they exist today. And so I'm going to read a brief paragraph from your piece, and hopefully you can expand on it. But it says, if money is not permitted its intrinsic capacity to absorb this scarcity, other resources will need to fill that void. This increases the cost of information production because there are fewer and fewer sources of increasing thermodynamic entropy from which to convert into decreasing informational entropy. Consequently, the system will experience a drag on productivity. Such an environment also manifests hidden costs like environmental externalities and systemic fragility, which are easily cemented into chronic problems that become difficult to fix. Now, I know that paragraph kind of covers off all the inefficiencies that are created from money, but I'd love to get your take on specifically kind of the environmental stuff.
Yeah, well, so, environmental questions always kind of come back to this core notion of resource utilization and how to efficiently use the resources we have available to ourselves. I think one of the things that I certainly have realized, and I think I don't want to speak for other Bitcoiners, but I think from my conversations and all the readings that I've done, is a common thread amongst all Bitcoiners, is this realization that energy is not actually scarce. It's our ability to harness it that is the scarcity. And when you are inflating your money and you're forcing people into consumption, by definition, you're taking interest rates down to zero. It's doing multiple things, because it's decreasing that excess savings, which creates a lot of scarcity that wouldn't otherwise exist. And what I mean by that is when there's that excess savings and that excess capital, it incentivizes investment and innovation and low time preference thinking. And low time preference thinking is paramount to dealing with an environmental issue, right? Because environmental issues occur on a scale of multi-generations, right? So problems we face and the problems your grandparents faced are going to have impacts that compound over time and that affect our children and their children and so on. And if we don't care, if we are so focused on the here and the now, then the cost associated with decisions that impact future generations will not matter to the society. So first and foremost, you have to fix that incentive. You have to fix the time preference incentive. And so that's one aspect where Bitcoin affects that. And again, to your point about, I mean, we don't have to get into all of the various environmental narratives and the ESG noise and all that stuff. But I think we can all agree, like you just said, that there is environmental degradation. There are tons and tons of habitat loss and ecological damage going on across the world, species extinction events and things like that are clear, whether or not you are a proponent of global warming or any of those other aspects. But what I meant also about the concept of forcing other people, forcing greater thermodynamic entropy through existing resources is, again, that gets back to asset inflation, where first of all, you're not expending capital in a with a lot of stewardship, because you don't need to, because interest rates are at zero essentially, and so the bar for capital returns is very low. So squandering resources has a very low cost. And also, you are going to find that savings technology any way you can, whether that's through acquisition of resources, natural resources, or the acquisition of land. I mean, how many billionaires across this country have been accumulating land for the last 50 years in agriculture capacity? And there's a lot of great, I think, I'm trying to remember the guy's handle on Twitter, Untapped Growth, I think, where he's done a great job of talking about the degradation we've done to our capacity to produce food, to very basic necessities, So again, and that gets back to the time preference conversation. So the other way is speaking of land, is the accumulation of real estate. And this creates all sorts of other problems because it incentivizes, quote unquote, hoarding of real estate rather than putting that capital into something that can actually have productive returns over the long run. And it also perpetuates the existing capital stock over any potential new capital stock creation, right? So if you know that in perpetuity, you will continue to get a great return just by owning some property, some real estate property, why would you invest your capital in a risky endeavor, a quote unquote risky endeavor, to produce even greater potential capital returns when you don't need to, when the bar is already set very low because interest rates are zero and real rates are negative. The system is incentivizing the inflation of assets like real estate. Why would you put your capital into another endeavor? So that's a very specific example of that kind of misallocation of capital. And that very capital could have been used to do something like harness the very energy we're talking about that is truly actually abundant, but that we squander through our activities within the system.
Yeah,
I don't know if that answered your question.
Yeah, well, I want to pull on this for a sec. So I'd love to get your thoughts. So, and again, this is one of the things just so surprising, doesn't get much, well, maybe not surprising in this day and age, but like I think it should get much more discussion in the mainstream. But the interest rate is a function of the capital stock and the time and risk preferences of the borrowers and lenders, right? And that from that emerges an interest rate, whether it's a singular one or different ones for different time periods in different places or whatever. So if you have artificially low interest rates, then those borrowers and lenders are getting untruthful signals about how much capital there is for investment, how, for consumption, for everything, right? It completely throws off everything. And so an aspect of that, and there are many outcomes or consequences of that scenario, but one is that you get a lot of capital destruction, right? Because people say, hey, the interest rate is telling me there's this much capital stock. And I do my economic calculation to say, like, that means that this amount of investment can yield this amount of return, and by these numbers, it works out. But because the interest rate is artificially manipulated, that means that a lot of those people making those calculations, from the get-go, those calculations are going to turn out to be wrong, which means they're going to make investments that are not sustainable, that cannot be productive, that cannot persist, and that capital will have, in some part, have been wasted, right? Unnecessarily so. So, and this is, this is obviously only permissible by having a money that's centrally controlled, whose supply can be inflated and interest rates can be manipulated as a result of that. How do you think about, and I don't think it's that there's that much point in like imagining what the world would be like if we were on a hard money now and regretting how we got here, but how much do you think right now, how much capital of the capital stock do you think is being destroyed versus how much is being replenished by just the era we're in technologically? So, and that's, as I think you discuss in your article, that's part of how the powers that be, let's say, have gotten away with these things, is because the technological deflation has allowed them to hide and obfuscate a lot of the, the theft and the capital destruction that they've gotten on with. But I'd love to get your comment on just capital stock, capital destruction, and where we are in that. I mean, is it too much, even with the technological deflation, is it too much? And are we not just completely destroying our capital stock as a society right now? And as a result, we're seeing so many problems emerge, be they environmental or social.
I think the biggest problem, the biggest destruction that is being perpetuated by low interest rates, because as you said, essentially when you keep interest rates artificially low, what you are essentially doing is creating an environment of negative real interest rates, which is creating a massive incentive to consume and not spend, and to create, which in turn creates even less of excess savings and less of an existing capital stock from which to pull on in the future, which affects resiliency and fragility and all of those things that, again, I mean, as we're starting to see with COVID, things shut down and started to unravel very quickly in terms of supply chain impacts, in terms of people's ability to withstand a shock to their income, because there were no excess savings. There was zero resiliency in the system. And so when you're dealing with a system like that has perpetuated itself through credit expansion, and that eventually that credit expansion has two main incentives. It incentivizes those close to the source of the credit creation, which is in this case, in the case of almost all of the situations we're discussing here, are central banks and the governments that control them, both directly or indirectly, and those who are close to those sources, right? So the Cantillon effect type of parties, and this gets back to the centralization of that, because when you create a system that has a great savings technology and that incentivizes the true allocation of capital based on the desire to consume or spend, and where that interest rate, like you're referring to, which is, I think, related to a very basic concept called Say's law, which was like invented back in the 1700s, which is the basic concept of how interest rates are set by the demand for consumption and supply between producers and consumers. And when you basically put yourself in between those two counterparties, like you said, you create these really perverse incentives, and they really compound on one another. So once you go down that route of fiat creation and credit creation, you cannot go. It requires even more monetary printing in order to perpetuate it, because once nobody is maintaining any level of excess savings, all of the capital stock becomes very centralized. There's a scarcity of capital. It's not really spread out among society. So there's pockets of capital, and there's actually pockets of massive excess capital, which is something we're seeing right now, which is the banking system itself has tremendous amounts of excess liquidity. It doesn't even know what to do with it, but it's not getting to where it needs. It's not getting to any kind of end user that can make productive use out of it. So literally you could light it on fire and it wouldn't change anything. But if you had instead a system that incentivized the excess consumption to be saved, one, you would have a a higher risk-free rate that would further incentivize productive use of capital out of necessity. This is where it becomes vicious or virtuous, right? Once you go down, once you make that choice, once you kind of go make a choice of what system you're going to operate in, you kind of, there's no turning back, right? So, and then of course, it also incentivizes the actual, purveyors of the arbiters of that system, who are the central banks, to abuse it eventually, right? I mean, all fiat systems eventually that power gets abused. So you have kind of two forces: one, who are the forces who are around that central bank, who are gaming it and using regulation, using rentier behavior, using their abilities as banking institutions to create a moat around that capital, and of course gaming it, which is through different mechanisms of financialization and asset inflation, because you have the current stock of assets, you have the current stock of capital. You don't need a new stock of capital. There's an excess amount of that in your hands, whereas everybody else suffers from that. And so it creates these imbalances. But to your point, how do you rectify those imbalances when everybody who's part of that system has an incentive to perpetuate it? And this is why the solution has to come externally. There's no other, I mean, it is no coincidence that Bitcoin kind of grew from a very organic process completely outside the existing system, because the existing system has no incentive to allow Bitcoin to grow and prosper. Now it kind of did that despite the existing system, and at some point we can talk about this, but that's a whole different conversation about how at some point that system will look to fight against that, because it will be a threat to the system. But yeah, I think the capital destruction is really the biggest thing, and the biggest part of that I think gets lost on people is what low interest rates do to the future. And this is why it becomes self-perpetuating, because a low interest rate is essentially a low discount rate. Okay, so you're taking future earnings and you're discounting them to the present at a lower rate, and therefore inflating the present value of those earnings, those asset values, whatever they may be, whatever those productive assets might be.
You're
and so you're essentially
forward.
Yeah, you're stealing from the future. And I talk about that in the second article. And I mean, that is a type of inflation that we don't really talk about. It's alchemy, essentially. You're basically borrowing from the future, but it would be borrowing if you were ever going to pay it back, but you can't, because you're hollowing out that very future that you're relying on to borrow against. Credit, the invention of a credit system in humanity only arose once technology started to take off. Because for many years, and who writes really well about this, you've all known Harari. He wrote two books, Homo sapiens and Homo Deus. And there's part of, I can't remember which book it was, but there was a part of one of those books where it really impressed upon me a very kind of obvious point, but that it wasn't obvious until I heard him say it, which is that, why did we start inventing credit? It was essentially came from confidence in the future, that the future would somehow be different from the present in a better way. And once that happened, you could borrow against that, right? And as long as the future continued along that path, you could continuously roll that debt and hopefully use that debt to create something of value to improve that future even further. And that will allow for even more debt capacity and more on it. And that's why these things become perpetuating, right? But when you were doing it to such a degree that you were hollowing out that future in the same way, that's why I love that guy with the handle Untapped Growth, because what we are doing to the soil is a very analogous example of what we are doing to our kind of future economic prospects. Because if you continuously borrow from it without doing anything in the interim to replenish the capital stock that you are utilizing, you will continually just have to borrow and borrow and borrow to replace the value that would otherwise be created. You're not actually creating value, you're just borrowing from it. And that only works if we sell ourselves the story that the future will always be better. And what concerns me is that eventually people will stop believing that narrative.
Yeah, well, there's a couple of things there, but it's so, it's so obvious and simple. If you artificially lower the interest rate, you're bringing the future forward. It's very high time preference behavior. And as money is the prime incentive director of humanity, or at least people that live in dynamic markets, you're obviously going to get high time preference behavior imbued in the people that are forced to be subject to those incentives, right? Versus if you let the market forces take over, they will put a truthful or a more organic price on the future and how much of it gets brought forward. And that presumably, with a money like Bitcoin, will instill a far lower time preference in the people that operate in that market, because they're subject to incentives that are just as powerful. They're just precisely counter, right? So it's so obvious how this stuff affects the culture and people's behavior and all that kind of stuff. But almost
I just want to add one thing
philosophical.
to that, by the way, John. One thing
Yeah.
to add to that is that it's obvious and it's also inevitable. Like, if this can only move in one direction, it's creating such imbalances that definitionally those imbalances will eventually not be sustainable.
Mhm.
And what's so important about that realization, and I can't, doesn't necessarily tell you as an investor how to time it, but what it tells you is that for something to, if there's something that can actually offer an alternative to that system, that as long as that alternative can survive to see that day, then it is also inevitable that that system will be what we end up with on the other side of that outcome. And that is why I think, I know Nassim Taleb is not well thought of right now in the Bitcoin community, but his book Anti-Fragility, I think, was so inspiring for a lot of Bitcoiners, because I think that is the killer app of Bitcoin, is its anti-fragility. Because again, what Bitcoin does is it's a savings technology that allows value to propagate in the way it naturally would. So it is just this pristine, clear connection. And as long as it can survive all of the instability that the alternative system is perpetuating in the meantime, in the interim, it is an inevitable off-ramp. And I think that's what is so misunderstood. And I think we're witnessing it right now firsthand with all the hash power that's moving out of China, which is that we've had 50% of the hash power essentially, or 35, 40%, depending on different people's estimates, move offline. And Bitcoin has survived. Bitcoin is, I think for a period, maybe we were mining blocks like every 30 minutes. Now we're back to essentially every 10 to 15 minutes. Like, it's just taking along. It is maybe not in its healthiest right now, but it is surviving, and it is surviving in a very robust way. And it will, of course, take from this experience and learn from it and become even more resilient. All that, as we know, in this specific example, all that hash power is going to migrate to other places that make such an event in the future less and less likely. And that is so important, because again, the system is just killing itself. I mean, unfortunately, I laugh about it, but like it's really tragic, actually. But and as long as Bitcoin can survive during that process and grow and learn from it and respond to all the various attack vectors that occur along the way, it is an inevitability. So to me, if you were going to say, like, what is, people talk about their favorite attribute of Bitcoin, like, what is, to me, it's the anti-fragility, because that is what's going to kind of guarantee that inevitability.
Mm-hmm. I'm going to read a passage, then ask you a question. it's related to what we were talking about a few minutes ago, but it said the more we chip away at our future's building blocks, the more we must hope for new blocks to be constructed to replace those missing from the edifice, lest the foundations begin to crumble and decay. If we lose faith in the future, the entire illusion evaporates. We are then pressured by an imperative to constantly sell our present selves increasingly seductive visions of future prosperity, no matter how vague and unsubstantiated they may be, and no matter how much our current behavior reduces the probability of such a fate materializing. No wonder we live in the age of pump and dump, the story stock, the SPAC, blank check companies that literally derive their value from the ability to sell a story about a potential future asset that does not yet exist, and many other examples of our escalating abuse of the future. With that kind of idea in mind, and also, related to everything we've been discussing, almost philosophically, this is what my question was going to be, but like, what is a negative interest rate? If we accept that, artificially low interest rates are bringing the future forward, robbing the future for the present, and natural interest rates are the opposite. It's that proper equilibrium. It's an organic equilibrium. What are artificially negative interest rates? What's the meaning of those?
So there's negative. Yeah, I don't think anyone has an answer as to what that would look like if we actually lived in a world. It's one thing where Europe has flirted with that, and the ECB has flirted with some negative nominal interest rates in various economies. It's an outcome that I think most central banks agree, at least on the surface, they agree that it's undesirable. And the reason it's undesirable is more mechanical in nature. Our current system isn't really structured to allow for it. But we've already seen what negative interest rates in a real sense, when I say, and just to make sure everybody's on the same page with these definitions, when I refer to negative real interest rates, I just mean nominal rates minus the rate of inflation. And we can argue about what rate of inflation we should be using and what's real and what's not real. But we all agree that there's some level of inflation, whether it's 2%, 5%, 10%, in terms of one's cost of living or one's hurdle rate. From an investor standpoint, that inflation rate, CPI might be less relevant. It might be your hurdle rate. So, for example, my background in finance, especially in recent years, has been in corporate debt, and so we are in the high yield market. We lent to junk, quote unquote junk bond companies, and really struggling companies. And by the way, that's one aspect I've seen in recent years, where all of these incentives get completely out of whack and perversely incentivized, which is I see many companies that should have filed for bankruptcy years ago that have been able to basically just kind of string themselves along quarter after quarter and roll their debt because there's someone out there who's willing to lend to them, because there's someone out there who is starved of yield. And that is because real interest rates are negative. And what is their alternative?
Well, even look at the MicroStrategy sales, and we all love Saylor and all that kind of stuff. But I mean, he's obviously benefiting from that very circumstance. For sure.
And he's doing it, but he's doing it. He is the borrower, So in an inflationary world, especially one with negative real interest rates, lenders are the cuckold, like they're the ones getting left as the bag holders, and right. The borrowers are the beneficiary. You should borrow. So Saylor's doing a speculative attack on the dollar with the most pristine asset ever created. He should do that all day. Yeah. I mean, obviously he's got a fiduciary responsibility, but he's got this fiat cash flow that he's earning. He's got a very stable software business that he's earning this fiat cash flow that is reliable, and if he doesn't do something with it, he's just accumulating excess cash in his treasury. And this gets back to the incentives of the system. So even someone who is very aware of how ridiculous these incentives are, he's going to play the game because he's inside that system, and he will play it until there's no game to play.
Yeah, absolutely. But it's funny, we always talk about fiduciary responsibility in business and shareholder stuff, but I wonder when the narrative that it's a fiduciary responsibility to own Bitcoin or even to spec attack the dollar with Bitcoin, like when will that become a fiduciary responsibility, right? Because there's
I think it already has in life insurance. I think a lot of it's interesting that a lot of life insurers were the first true institutional investors to start investing in Bitcoin.
Right.
And the reason is because they have these huge fiat liabilities that are very long duration, that are going to come due many years from now. And even if inflation is only 2%, well, a 2% inflation rate in over 50 years completely destroys that capital.
Yeah.
And when there are very few alternatives from which to earn a yield above and beyond that inflation rate, whether it's 2, 5, 10%, it becomes, like you said, a fiduciary duty to make that long-term bet. And it's interesting to me for two reasons. One is that of all institutional investors, I would say, life insurers and kind of pension funds and sovereign wealth funds are the kind of lowest time preference types out there. Hedge funds, my fund included, that and a lot of my peers who are in the hedge fund industry have a very high time preference. They got to get returns quarter to quarter. They got to bring on new investors, and just like companies, like a lot of companies are very, are gaming each quarter. They want their stock price to go up. They have the executives of these companies have stock options, and they have to hit certain hurdles, and they're thinking in a very short-sighted manner. It's interesting with a guy like Michael Saylor, who can really think very long term about this, because he has, I think, over 50% control over his board. So he has that luxury, but it's very rare to have that kind of leeway. But so it's interesting. A lot of people talk about all this institutional adoption that's occurring, and that term institutional is I think a little overused and a little vaguely used. I mean, sure, family offices and hedge funds are all buying it. If you look at all the on-chain data, all those kind of short-term whales that have been selling recently, a lot of them are those types of investors. They have high time preference. They see momentum roll over and they sell, and they're just kind of trading around this vehicle. But what's going to be really interesting is, I think, what you're hinting at, which is when the fiduciary incentive of very long duration investors becomes so overwhelming that to not invest in Bitcoin would be, massively, yeah. And I think Plan B has a great chart that he put up in his stock to flow cross asset model, or it may have been in another article he wrote where he was talking about efficient market theory, which is that, well, if the market is really efficient, if all available information allows market participants to price in the fair value of an asset, why is it that the stock to flow model works every halving period, right? Or at least historically has worked. And he was saying, he had all sorts of interesting explanations as to why that might be the case, which are not relevant to this conversation. But what was relevant was he showed this chart of just the simple math. If you are an investor, and just the asymmetric nature of the risk reward profile for Bitcoin, it either will be the money, it either will be the base layer money of the future, or it won't. And even if it isn't, it will probably still have some savings vehicle kind of value, some network effect that is somewhere well above 100 billion, 200 billion, even 600 billion, where its current market cap is now. But if not, it is the most asymmetric trade that has ever existed, probably, or at least existed anytime in our lifetime or our grandparents' lifetime. And so the simple math is, if you are an institutional investor with a long duration outlook, putting 1% of your assets in Bitcoin will increase your long-term return profile by orders of magnitude, even if it went to zero, even in all those probabilistic scenarios where it could go to zero. Just because of that, even if you mark a very low probability, on a sub 1% chance that it does, go over $1 million for Bitcoin or even more, just that one probability weighted outcome increases your kind of average expected return tremendously. So it does become irresponsible at some point not to invest in Bitcoin. I do think some really forward thinking asset managers, of course, are there. And by the way, those kind of asset managers, that's a long process. That's an 18-month process. That's not like, hey, I get it now. They have lots of, speaking of fiduciary, they have lots of people they have to convince
Right.
to get there. And I think that's what a lot of Bitcoiners may be missing. That process is going on probably right now. And a lot of those investors don't care that Bitcoin went down 20, 30, 40, even 50% in the interim. I mean, great, fine. They can buy cheaper when they finally are approved, but they're thinking 10, 20 years down the road.
Well, that's why I think the narrative plays so much on a dynamic like that, because, inherent in a fiduciary duty is a value judgment on how you execute it, right? And so, like, you're only held to it as far as your own best judgment will allow you to be. And so once the narrative of Bitcoin really starts to emerge and more people get it, and that kind of snowball effect happens, and I think, naturally you'll see more pressure, the conversation shift to the fiduciary responsibility of holding Bitcoin, if not, going full spec attack like Saylor has done. But I want to ask, like, so you operate still in that world. Two questions about that. One, how many of your peers get Bitcoin? And you're obviously super orange pilled now and probably want to talk about it all the time. And you're probably the Bitcoin guy and all that jazz. So what's that dynamic like? And two, what is it like to still have your day job be in a system that is completely perverted, corrupt, days are numbered sort of thing? But obviously you're in a, as you were saying, you're in a position to basically take advantage of the perversion and how messed up it all is. Like, what's it like for you to be orange pilled, but still be, fully in the other world?
Oh, that's a tough question. And I have to be a little careful how I respond, given my own,
Sure.
my own kind of fiduciary responsibilities. But I will say this: to me, it is overwhelmingly obvious that the future of finance, even I know DeFi is a very loaded word, and I don't even mean DeFi within the current kind of system that's existed since 2020's DeFi summer and all of the kind of casino DeFi that went on Ethereum. I actually think, not to go off on a side tangent here, that a near future narrative for Bitcoin, a new use case that people will start getting excited about with Bitcoin, will be DeFi, or the stack. The stack of layering that's starting to be better understood and start to really develop its own network effects. Of course, Lightning is starting to become more robust as a network, and things, applications that are built on top of Lightning, such as Strike, are gaining a lot of traction in terms of how, especially the speculative attack can be conducted on a nation state level, against the kind of dollar system and as a global reserve that a lot of these nation states are forced into. But to answer your question, it's difficult, because once you see it like that whole concept of the orange pill, and I like to use like a slightly different analogy. There's a writer, David Foster Wallace, who wrote this great book called Infinite Jest, and it's a good book. But actually, one of my favorite things that he's ever said was in a commencement address he gave, called "This Is," and it was a joke he talked about where this is water, and I'm going to probably butcher the joke, but it was essentially, two fish swimming by, and some older fish swims by them, and he goes, "How's the water, boys?" And they look at each other afterwards as the guy passes, and they say, "What's water?" So when we are all swimming in a current or in an ocean that we've been in for our entire careers, it is often hard to see that there's something outside of that. And then once you do, it's very hard not to see that you're swimming in this polluted water. And so, yes, it does become difficult. And one of the reasons why I started communicating and writing more was because I was already doing that internally. I was already trying to orange pill colleagues and friends within the industry. I was trying to just give back for free all of the months and months of research I had done on my own, and speak in the language of Wall Street people that I know need to be spoken to in that language. to better understand it. I mean, you doing what you do in this landscape, you're talking to people all different walks of life, and I'm sure you have to tweak your message when you're talking about the subject to adhere to the background of the people you're discussing this with. So if you're talking to a developer or a miner or just a complete novice who knows nothing about finance, technology, or anything, who just needs to be kind of to understand why Bitcoin is important, you need to talk on a very kind of basic, high level. You basically need to tweak your arguments to adhere to their thought process. And so I was trying to do that within the world of finance. And I also started to see that in the Bitcoin community, as I started kind of lurking on crypto Twitter, started seeing that there was a little bit of a hole there in terms of some of the communication that was being lost or oversimplified when it came to some of these discussions that could bridge what Bitcoiners knew and what some of the just experience in finance had taught me over the years, and kind of bridge the two. And so I'm enjoying doing that. I look forward to doing more of that. And, I've started working to a greater degree with Bitcoin Magazine to do that and going forward. And some of the ideas we've kind of talked about today, and I've gone off on a couple tangents, are aspects of other kind of pieces I'm trying to work on and thoughts I'm trying to work on. But within Wall Street, I have definitely noticed, to answer your question, a greater interest in DeFi than in Bitcoin, because it's a shiny ball. It's this technology, right? Like people love to talk, as we know, in 2017, there was blockchain, not Bitcoin. People on Wall Street love to think that they're smarter than the next guy. Exactly. And so the way to be smarter than the next guy is to say, well, Bitcoin is simple. Bitcoin is simple. It's digital gold. What's more interesting than that is like all these use cases and disruption. People love these catchphrases. Oh, we're going to disrupt finance. But I think they don't realize that they're starting from the opposite direction. You got to start from the ground up. And all of those applications will all eventually be built on top of Bitcoin, and that the actual network effect. We talked earlier about network effects. The actual network effect, and this is what I love. Idan Yago of Sovereign talked about this recently, and I thought it was such an important point, which is that the network effect is based around the asset itself. ETH doesn't have a network effect. Ethereum has a network effect because it created an environment that attracted developers. So that did create a network effect for a time, but that is not a sustainable network effect, right? Because eventually, if you can't scale, developers eventually start to get frustrated and they move elsewhere. So it's just kind of like how social networks, before they fully scale, can easily, crumble, and then how a social network like MySpace was able to be completely usurped within a 12-month period by Facebook, because of certain mistakes and certain inabilities to scale or adapt. But if your network effect is based on an actual asset that has this intrinsic value, that is much more sustainable. And so I think that's what a lot of people miss when they're looking for the complexity, because Bitcoin is very complex deep down, but on a surface level, it's very simple. And I think a lot of Wall Streeters want that complexity and kind of, but they'll make their way back. But I think so that's a frustration that I've run into in some of my conversations.
How it achieves what it does is complex, right? But as we've been discussing, like what money is so insanely simple, right? It's just meant to communicate preferences of people and reduce uncertainty and allow you to store your time for the future and all these things. And I love how humility is such a critical component to believing or seeing that something so basic can be so profound. And I think that's why a lot of the Wall Street bros don't get it, because let's be real, like they're not considered the most humble group of people in the world, right? They're kind of like
that's very true.
Kind of egotistical and arrogant sort of crew. At least that's the perception. And it makes no wonder they go for the shiny ball, right? Where they also think they can make a quick buck rather than something that's simple but profound that will not only, improve their situation and their returns, but this, like most Bitcoiners could probably make money outside of Bitcoin. The returns on Bitcoin will be stellar, of course, and have been in many cases. But this is a movement far greater than any one Bitcoiner, and I think a lot of Bitcoiners see it that way. That this is an important thing for humanity, and the Wall Street bros are not typically in the category of people that care too much about that component of things.
Yeah, and this gets back also to our conversation about anti-fragility and that fiduciary responsibility point that you noted, because I think at the end of the day, despite some of the kind of moderate orange pilling I've been able to do with some colleagues and friends in the industry, if you don't do the work yourself, you are going to have your resolve tested. And that's what the volatility does, right? As we know, right? And that I've seen just in the last few months, I've seen that resolve tested, and I've seen many of those people bail. Because I think at the core, so many people, while they get it, and they get it on a very kind of high level, and they, okay, yeah, I get it, digital gold, blah, blah, blah. When shit hits the fan, they're like, they're like, yep, it's a bubble. Like, I think everyone on a surface level is waiting constantly over 10 years to prove that Bitcoin was in fact a tulip bubble or something. And that's where the anti-fragility comes in, because while there are bubbles in Bitcoin, and I think it would be intellectually dishonest to try to counter that argument. First of all, bubbles are really valuable. Bubbles bring
inevitable
critical capital into a burgeoning new industry. Of course, eventually that creates short-term excess, but over the long run, the internet had a bubble, but the internet didn't go away, right? Like, so in fact, without that bubble, the internet may have not had the robust kind of infrastructure that would have been necessary for it to scale later on when it actually caught up to the innovation that occurred down the road, because people got ahead of themselves in terms of their pulling forward, that you talked about it earlier, pulling forward the future into the present. That's kind of what a bubble can do sometimes. So Bitcoin, of course, can go through those ways, but there's so many people who think, this is it. This is the moment, it's done. And every time that happens, and that's also important, just like the bubble is important, the popping of that bubble is important, because what happens is it doesn't die. And that proves to maybe those people who you said who were a little more humble to think objectively, say, I was wrong. Yes, maybe it was a bubble, but look, it's still here. It's still pumping. It's still churning. There's still innovation occurring on it. It's still surviving through this kind of cyclical period of lower demand, and the entities on the network are still growing day over day. Like, this is interesting. I mean, that's kind of what drew me in. I mean, a tulip bubble didn't occur 5 times. It occurred once, and that was over. I mean, so the analogy is, as we know, is ridiculous. But and it was also like the tulip bubble actually was like very small. It's been history
like
made
6
it a much
to 8,
bigger
9
deal.
months or something like that.
And like I think most people in Holland actually like didn't even know about it or didn't really experience it. It was like,
dude,
it was.
Imagine being like Nuriel or Hanky, any of these guys. They're literally calling Bitcoin a bubble at $10, and then still at 30K. I mean, like you
the
said,
old broken clock.
It's pure intellectual dishonesty and Bitcoin derangement syndrome and mental gymnastics and all that jazz. But I think,
but those are and those are the people on the extreme end who have no intellectual flexibility, and that's fine. Like, they're gonna kind of go the way of the dinosaur, but there's most people who are somewhere in between, and those people might be skeptical, and maybe they didn't do the work this cycle, but they listened to a buddy like me kind of tell them to buy some. They did it. They lost faith. But next time around, when Bitcoin is inevitably still here, they will give it a deeper look, and they will go down the rabbit hole themselves, and they will have the same conversation with someone else, and so on. And this is how kind of the network grows organically over time. And that's why, through all of these trials and tribulations, if it just doesn't die, it will inevitably grow.
Mm-hmm. Totally. That might be a good place to put a pin in this, man, unless you have any other things you wanted to discuss.
No, this is good for today. I know I've been rambling for a while. I'll give your ears a break.
It's been great. I look forward to doing another one in the future when you've written some more articles and hashed out some of the ideas. And I think this is really, in particular, the Bitcoin information theory and talking about money as information is something that, in Bitcoin land we'll probably be doing more of and trying to push it into normie world, because it's so simple, but it's, like we were discussing with Hayek, it's still far away from people's consideration or how they're looking at this. So I think it'll be a topic of much discussion.
I agree. I agree. And just to add one quick point to that is that as I mentioned before, as peer-to-peer technology and innovation starts to really compound, and the need to specialize further, the need for people in their jobs to be able to specialize and have micro tasks and to be able to be more malleable and adaptable in the work they do, in the professions they have, becomes so much more vital and such a bigger part of what we consider an employee to be, or a person's job to be. As that definition changes, which it inevitably will more, then we will much more start to focus on a money that can scale that. And I think that's a way in which information and Bitcoin's ability to help information scale in an efficient manner will become much more appreciated. So I think that's I agree that that's a topic that should warrant a little more discussion.
100%. Where can people find you writing, connect with you on Twitter, all that jazz? You want to direct people anywhere?
Yeah, so I'm on Bitcoin Magazine. I'm Aaron S. You can find my articles there. Like I said, I have a couple more that are kind of in the pipes. On Twitter, I've kind of neglected Twitter for a long time, and I've decided to kind of give it a go. So I'm Ludi at Ludi Magister, LUDI MAGISTR is my handle. Yeah, that's the best way to reach me.
Dope, man. Well, look, I appreciate you taking the time for the chat, and look forward to the next one. So take care.
Likewise, Sean. Have a good one.
See you, brother.